Good morning, everybody. Welcome today to the Option Hour. My name is Chris Bolson. I'm going to be chatting with you guys today. I'd like to welcome everybody. I know Victor's been in here the last couple of weeks. I've been in here with him the last 3 weeks. Out sick today, so I spoke with him yesterday. He's got a sore throat still. So we're going to be going solo a little bit today. But I definitely welcome you guys to please give a call in if you can. I'd love to talk with you guys about positions, strategies, and so forth. Number, if you'd like to call in, 877-927-6648. Again, 877-927-6648. And I'd be happy to talk to you guys pretty much anything you're looking for here. So definitely, as we're getting into options, obviously one of the things that we generally speak about, and of course it's kind of topical today, is keeping an eye on the VIX. Looking at volatility in the marketplace. And then we were talking about last week, it was kind of the discussion about, all right, we're below 20 in the VIX, and kind of saying like, wow, this is really kind of new territory, at least since kind of the summer of last year, and seeing, would we stay here, kind of waiting for confirmation, how is that going to go? You can pretty much see we followed through and stayed below that number here for a good week now. We've been below the 20. We kind of popped up a little bit yesterday, but not too much. And for the most part, I would say that this gives us at least a little bit more comfort. I don't want to say confirmation at this point, really, because I don't feel like too much has happened in the last week, but at least more comfort in terms of saying the fear is subsiding a little bit. We can see that fear in the marketplace kind of going away. Now, when we did go back below for just that brief moment, there was a down move in the market. So definitely people, I think, are ready to be afraid quickly if they feel the need to. But definitely a little bit more comfort when we see this kind of price level and this kind of now what was support become resistance in the VIX. So below 20, you definitely start to feel a little bit more comfortable with yourself, especially versus where we came from in the 30s and the mid-20s for quite a while here lately. Now, one of the things, of course, this directly, for the most part, or I should say almost indirectly correlates, is going to be with the S&P futures. So we can take a look now, and it's almost the same thing that we've talked about for quite a while, is the price level in futures correlating with the price level in the VIX. And you can see here, just bringing in a line real quick, as far as 1,300, was support, it was resistance as well. We've kind of bounced around above it once before, below, and then coming back and challenging it once again. And it's almost the same story, but on the opposite side is we are now above it for, well, a good week or so. So we're kind of talking last week again. All right, we're above the price. Where do we stand? Are we looking for confirmation? What's going on? And for the most part, we've kind of stayed up here. So you get a little bit of comfort again back into the marketplace. Now, one of the things that I believe this kind of goes to kind of emphasize a little bit is you see something like last week happen, and we're in a market environment now where essentially nobody wants to be last on a trade. You know, they see something change, we break resistance, and they want to be the first one because we're going to go ripping and roaring higher, right? And this kind of goes to that fact as far as sometimes it doesn't hurt to just wait a little bit, take stock of the market, try to get a feel for what's going on. And I know for stocks and things like that, there are times where, you know, time is of the essence. You have to really go firing away. But sometimes with the overall kind of broader market, you can find yourself in a situation where giving yourself some time isn't necessarily the worst thing in the world, right? Now, that being said, if you were shorting volatility last week, you essentially have a week of decay with not really any price action. So that being said, if you're taking a longer-term play, essentially now, at least in my opinion, I feel a little bit better about doing so, especially after seeing now that we are kind of above these prices. I would say that we did bounce off that support here, 1,300 or so in the S&P futures. Still does feel fairly firm. So I'm not convinced quite yet, again, that we're going ripping higher. But I definitely feel a little bit more comfort in the marketplace. And when you look at this in line with the VIX, I think most people kind of at least get that feeling. But ready to be afraid very quickly, I think, if we dip below. Back below that 1,300 number, because of course we can look back to just a few months ago, and when you see something like this, and you see this pattern back here that people are very attentive of right now, we broke it, and what happened? We really, really gapped right down in the marketplace. So people are kind of weary. They tend to think that history will repeat itself. It's going to happen again. Again, you see these two bumps back here. If we get a couple of them, looks like a little bit smaller bump here, but if we get a bigger one, kind of coming up, and then we do break through that 1,300 level again, I think that's the fear, is everybody's kind of saying we're gapping through. That's why we talked about last week as far as what kind of positions do you want to look at in these kind of environments, right? Short calls, because you kind of think that we're going to stick around or maybe rally a little bit higher. You give yourself some room to still capitalize on that upside. But remembering that volatility relative to the past here, right, going back looking at this volatility, relative to the past few months is pretty cheap. We look at this is as cheap as it's been in a pretty long time. So you start to think, all right, well, I can protect my position with relatively cheap volatility. So buying puts at relatively low prices versus where they were. And, of course, you want to buy puts when the market's higher anyway. So this is the kind of time where people tend to collar their positions a little bit until they feel a little bit more comfortable with their positions, with their trades, and with their, we'll say, the forecasting as far as where they really do think the market is going to go in the future. So for the most part, it's been kind of no news, right? Overall market, everything's kind of stayed for the most part, again, pretty much the same. As far as any kind of other products, I've got a few up here. The dollar's kind of come off a little bit. You see oil as well as kind of now below that 100 level. The euro is one I know that a few people have been following. I'll just pull some futures up here real quick. Euro kind of rallied here over the last week or so. And you can see it got down to $1.26 and has rallied all the way up to above 132. And already people are saying, look at these now new lows. And it sounds kind of funny to say, wow, new lows in euro after it's had such an aggressive move to the upside. But it's definitely one that I think that the euro has really been one of the more volatile products that anybody's traded over the last few months, really based upon those different the different news, economic, political coming out of the Eurozone. So I don't anticipate that changing anytime soon. That being said, you see that kind of movement in the euro as well as the dollar overall has been gaining strength lately. You're going to see those kind of patterns. The other things that we'll kind of pull up, and I'll probably get into gold a little bit more later, getting into options, depending on how many of you guys give us a call in here today. But gold is kind of on another rally again. We've gotten up a bit higher back in the summer, of course, with that huge rally, and then we've fallen into it. It seems kind of silly to say a range, but 1,600 to 1,800 is a pretty big range, but we're still there and approaching the upper end of that. So definitely gold with this move to the top side is something you really kind of want to keep an eye on a bit. In my opinion, I think products like this, like once it happens, you see the move, it's almost like, well, that's not going to happen again because everybody knows it came back down, so everybody's going to start selling it right at the top again, kind of preventing it from ever getting that high, and you start to have less dramatic moves. But because of how many influences that come upon gold in terms of the price of it itself, economic, the dollar value, and things like that, this is something that if the right things kind of line up, you can really see it get ripping around as we have in the past. So, yeah, they're throwing that number up there. Definitely, guys, if you have any questions, please, questions, comments, want to talk about anything, your positions here, give me a call, 877-927-6648. Love to hear from you guys if you've got something on your mind. So that being said, let's go ahead, barring anybody calling in here, let's go ahead and jump into some of the things we were talking about in some of the previous sessions here, right? And one of the big one I know we all kind of had our eyes on was Apple. And this is something that just will not go down over the past few months. I guess you can look longer and say years, right? But look at this market, In just June, it was 310, and I remember thinking at 310, like, this can't go. How much higher can this thing go? And when you say things like that and it moves another 50% higher, you really start questioning what do you actually know about the marketplace. But this is one of these things, and I remember analysts on TV, CNBC, and things like this back in last summer, and even in the years before that. Apple is one where they say it's overvalued. The company can't be worth that much. Right now, I think Apple's number one in market cap, just ahead of Exxon. it can't be worth that much. It's overvalued. But if you want to trade it and you want to make money, you have to be long because it's going higher. And I still almost feel like that's the case with Apple. Is it's such a performer, and people are looking at the possibility of how well they can do in the future, and they come in and set high expectations for themselves, but they actually meet those expectations. So the stock continues its meteoric rise, and it almost seems like there's no end in sight, right? So the trade that's really been working in terms of Apple has really been essentially just selling the put spread. And I know people who have done condors in Apple got burned a little bit based upon the strikes that they were choosing, but to really get any premium on the call side, you have to bring those strikes in a little bit. And, of course, that's where the risk is that it just keeps going higher and does not stop. So that's one of the things that I am kind of concerned a little bit about selling the call side. I feel like almost ever you can sell a put spread and it's just going to rally higher, and you can almost look back at the down moves, right? Up at 400, went down to 360. Got back up to 420, down to 360, up there again, 360. So you can kind of give yourself a floor at least. Then 380 was the bottom, and now you see kind of a little bit of 420, I would say, is the next support. So you can kind of see there is support in Apple. I still feel like once the kind of tide turns and the public sentiment turns, right now, if you ask anybody and anybody's given a recommendation on Apple, they're saying buy it, because if you say anything else, you're the only guy who's saying to sell it, and nobody wants to be the other guy. Even if they think it is going down, nobody wants to be that guy because it's too much of a risk. And if you were that guy, you're probably out of a job because you've been wrong all year. You know what I mean? So it's one of those things where everybody's just kind of saying buy it, but you can kind of think, like, if that sentiment changes, it's got room to go, right? 6 months ago, it was $300. So there's definitely room for this to drop should it go, but barring any of that, and that tends to be something that takes one of two things to happen. One, some major news about the corporation, the company, that something isn't correct, right, and in terms of maybe earnings were misstated or something like that, or it takes a long time in terms of not meeting expectations and really kind of changing for the long term public sentiment. You kind of say, well, barring any of those two big risks, you almost still feel comfortable being long this stock. But I kind of talked about it last week as far as I'm not the best guy when we're talking about what positions to put on when we're at all-time highs, because you don't really have a basis for how high can we or will we go, right? This thing can go to 500, go to 600, and it's kind of saying, well, I don't know because we haven't done there. So you feel a little bit less confident as far as making those kind of statements. But one thing I do know as far as looking at Apple here is volatility is pretty low. Let's go ahead and take a look at implied volatility. You can see kind of the low range for implied volatility has been about 20%. And we can see now on this implied vol chart, that's about where we are right now. So this is really, people, when we talk about the overall market is at 20%, and people feeling good about that, this is an individual company where one person can change something or one product can change something. So you tend to have higher volatilities is all the way down to 20%. Now, I used to be a market maker, so I come from it's almost impossible to get me out of that mindset. Low volatility, you start covering positions, you start thinking, all right, well, everybody thinks nothing will go wrong. So what happens if something goes wrong? Everybody freaks out, right? So these are the kind of times you start thinking about maybe like a contrary play. Chances are you're gonna do something like buy puts or sell calls, and it's going to burn you. But if you ever get into something where that actually does come out to work right, it's going to be a major winner based upon there's no fear at all right now in Apple. None at all. And if any fear comes in, you can see that people are going to scramble because it's not about being the last right now. Nobody's afraid. So you're going to be the first if you start going, and that tide could get some momentum going the opposite way. So definitely something. If you are long Apple And I would vouch to say that probably a decent amount of you guys are, just based upon look at what it's done. You know, I feel like everybody says, oh, you have to own Apple. So these are the kind of times, low volatility, you want to start thinking about protecting yourself to the downside. Because if you are long, you've been making money. You've done very well for yourself. You don't want to give it back. And when we start seeing things move to these kind of meteoric rise, it could gap down quickly, and you give everything that you've kind of worked months for back in a very short period of time. So again, I'm not saying Apple's going down. I'm not saying Apple's crashing. But if something negative were to come out, look out below, because it doesn't look like there's anything glaring here that's really going to protect Apple from that negative news if everybody really starts getting on board with that. So we'll look at a little strategy here real quick, but definitely if you guys have any calls, again, please feel free. Call in. Love to talk about your positions, your strategies, any kind of stocks you have going on there. Give me a call. We'll cater this to you guys. So 877-927-6648. Again, 877-927-6648. Please feel free to give me a call. So one of the things we talk about here, and we kind of use the implied volatility to gauge not necessarily what direction you should play or what your move should be, but really about what your strategy should be in terms of Vega position. So I know a lot of people kind of play that condor position as the typical kind of collect theta, fairly neutral market, maybe some direction going on in there. But for a fairly neutral stance, collecting theta, risk defined, and going from there. This is really something that if that is kind of your play, you want to start thinking about switching it up a bit. And when the volatility gets down to this kind of level, the reason I say you want to switch it up is because you're short Vega. Even if we get a move down and we stay within your range, if that Vega really pops up to here 30% or so, which is even still relatively low based upon where it's been, that could be expensive because you could be right on your play, you stay within your range, but just based upon that Vega change, especially for the short term, you're losing money on your trade. And that can be a difficult thing to handle. Because now essentially you're thinking, well, people are scared now. I feel a little bit more like maybe we will move, and if I want to close my position, I'm losing on it, even though I'm still in between my strikes. So you definitely want to keep an eye on something like that. But one of the alternatives you have, as far as still playing a fairly neutral market, would be moving into something like a calendar spread. So we'll just go ahead and look at both of these real quick. And I'm just going to pull strikes out of the air here. So we'll throw March in. We'll move these strikes out a little bit. And for the heck of it, we'll go 420, 410, and how about 480, 500. So just go ahead and look at that. And if I could do my strikes correctly, I'd make this a little bit more even. So we'll do something like that. So there's a short iron condor. I think we're all kind of familiar with this risk graph, right? You want to stay within this range, and you're going to do just fine. The problem is if implied volatility goes higher, you're going to see this white line, which is the current P&L expectation, to really come down because you're short Vega. Volatility rises, that's going to hurt your trade. So the thing you want to start looking at here is you say, well, I still have kind of that same expectation. I think we're staying in a range. How do you still capitalize on a similar type strategy, but still protect yourself, and we'll pull this up here, from this large negative Vega number, right? And we'll just go ahead and switch this up a little bit and say, instead of doing an iron condor, we'll look at something instead like a calendar spread. All right, so we'll just go 450. Come on down to March. Short the front month, buy the back month. Go ahead and look at that risk profile. And you see you have the same type of strategy, and you can certainly play with this a little bit, and the strikes are going to make a difference as well. The same type of strategy, a neutral market, is going to be beneficial for you. But if we do kind of move a little bit lower and that volatility does come back into the marketplace, you're going to be okay because this is a long Vega trade. You guys see this? We're looking at just the calendar. Here's the Vega position. I'm long 240. So you can say, barring any move, take the move out of it. If we go from 20 to 30%, That's 10 points. You're going to make $2,400 on the Vega portion of this, right? Conversely, let's look at this Iron Condor. If we go from 20 to 30%, you're losing about $2,100 on that trade. Every point, you're going to lose that $200. So keep that in mind. It's very similar strategies. You want essentially the same thing to happen, but should the market turn and you're off a little bit, instead of here, you're losing on the direction. You're going to lose on the gamma. You're going to lose on Vega as well. 3 strikes against you. At least here, if you come down to the calendar, you're going to be okay on the Vega, and hopefully that offsets some of your losses as well. And you can definitely play around with expectations as far as how far do you think the price goes, where do you want to put different kinds of orders in there, how high do you think volatility could go if we start moving back in another direction. Those are all things you want to kind of keep in mind. But remember, when we start getting to low volatility situations, you definitely want to keep an eye on your Vega position, because that's where you can really cut down on your expenses, and in the most part, even capitalize on a trade that you thought was great, you thought was good. You can make it great in a lot of cases by taking that into account as well. So you don't have to change your strategy too much. You can keep the same concept and really focus on not giving away that money should that Vega expectation change. And this is one I feel a little bit more comfortable with this Vega, getting long Vega in this product, because, again, if we go back here to the implied volatility of Apple, this is going back a year. We're on the lows for a year. Now, we should be with the market as high as it is, but that's still pretty important, because that's really saying that we're less afraid right now than we have been at any point in time over the last year in Apple. That's a pretty bold statement, and it's not me saying I'm not afraid. It's essentially the market expectations as far as what people think about this stock. So just one kind of thing to throw in there, to kind of, not say throw a wrench in it, but throw a little piece of information out there like, hey, this might be something, not necessarily to change your mind or to make a decision on, but you definitely want to have that in the decision-making process when you're choosing your strategies and trades. So move on to a couple of other things here as far as a couple of different positions and trades. But definitely, guys, please feel free. Calls coming in. I'd be happy to talk with you guys. Again, the number, if you don't have it there, 877-927-6648. Please feel free to give me a call. I'd love to talk to you guys. So let's go ahead and pull up a couple of other things, though, as far as what else is going on in the market. We're on the topic of Vega here. So I want to just look at something like Baidu. The reason I want to look at Baidu, and this is going to be a little bit skewed because we're looking at 1 month out, but if we're looking at Baidu, which was supposed to have earnings yesterday, and this is actually something that might have worked out okay, but supposed to have earnings yesterday. It was trading about 130, and we can look now. The weekly straddle is worth about 584. That's about where it was yesterday. We're 126, up 4 points. So about 585. A lot of people kind of play these earnings, right? I'm going to take a shot, get long the straddle, long vol. Hopefully we gap and move somewhere. And the one thing that we don't necessarily take into account when we're calculating our risk is what happens if they change their mind. So Baidu was supposed to have earnings yesterday, and news came out. I want to say it was in the middle of the day that they did come out, but I don't know if it was official until after the close, and said, we're not doing earnings until the end of February. So that essentially takes a trade that you had in Baidu in February, if you're playing this long straddle, and completely destroys the implied volatility. So let's just take a look back. We'll look back 1 day. I'll pull Baidu up real quick and just look at the closing markets. Here are the weeklies from yesterday, and the implied volatility, we can just kind of look across here, is about 65% versus 53. So down 12 points in 1 day. And let's just see where that straddle was. I want to say it was a little bit higher. So 130. So the straddle about 780 at the end of the day is where that thing closed out. So 780 the straddle's worth. News comes out. We're all expecting announced earnings. Hopefully, if you have this kind of trade on, it's really good or really bad. You see the stock go all over the place. But again, the news that we don't expect, we're not telling you, we're waiting a month, what happens to the product? Well, the first thing that happens is implied volatility gets crushed because now there's not that one big driver, that one big risk kind of hanging out there as far as what could move the stock one direction or the other. So you see the implied volatility come down huge. That was a terrible trade or a terrible position if you had it on, because what did we just show here? It was 7-something, now it's 576. And really the one saving grace as far as why is this even 576? Because the other thing that happens when the news like that comes out saying we're not telling you our earnings, we're going to wait, is typically it's not because, oh, we have so much money to count, it's going to take us a while to get this news out. It's typically like, oh, we have a little bit of trouble here and we want to make sure we state this the correct way or whatever the case may be. So, of course, the indication is what's going to happen to the stock? I'm afraid. Why are they waiting? Something bad. So everybody gets kind of freaked out. You see the stock move down. So the one kind of saving grace preventing this thing from being zero in terms of volatility really getting crushed, premium getting crushed, is this net change as far as the stock dropping almost $4 in one day. So you get a big move like that, it kind of saves your trade a little bit, but it's one of the things you need to be aware of. And this is why a lot of times I'll tell people, if you're doing these trades, again, think about the total premium you're paying, because we talk about what's the risk. The risk is volatility going to zero, you buy an option, and they expire worthless, right? Well, chances are it's not going to expire right at 130, but that's really the true risk. If you bought that thing for 770, you lose 770 if it expires right on your price and they both expire worthless. One of the things you want to think about, especially with these earnings plays, is really that vega. What happens if they don't announce? What happens if it's not as bad as you thought or not as good as you thought and there's no move? Like any little thing can really just crush that volatility. So I'm at fault as well a lot of times where I'll say, well, I'm risking 770, but it's not staying still and we have a day or two left. So what are you really risking? Maybe you say $500 or $400 and try and guess. And then you say, well, how much are you really trying to make off of that trade? This is one of those things, although uncommon, it can throw a wrench. And being that it's not an American firm, I don't want to say it happens more often, but it doesn't surprise me as much when you hear a company like Baidu say we're not reporting, we're going to wait. You know what I mean? Because we've seen it time and time again, especially from Chinese companies, as far as they say one thing and a few months later, 3 people on their executive committee and things are gone and the statements weren't exactly correct and they weren't that clear, so they have to restate some things. So I think that's one of the reasons you see the fear as far as that stock really coming off today. But you have to be kind of observant of the premium that you're paying, because that really is the true risk of the trade. And sometimes it's not a terrible idea just to throw in some offers on something that is further away. You know what I'm saying? So we'll just pull up something real quick. And I know it's going to be a little bit lower volatility today. But you might look at something down at like the 120 strike, maybe something up at, does that only go to the 140s? So up and down as far as selling some options to the downside and upside, try to bring some of that premium back in. Now, you don't want to do it if you think we're going to rip right through those prices as well. But if you're just trying to lower that total dollar risk that you have in a trade, that's one way to do it. Because you essentially, if you sell something, you're taking a credit back in. It's not just the debit paid for the spread. So a lot of times, keep that in mind. It's not just go out and buy a straddle, buy a strangle, and hope it just rips, goes to zero, or flies higher. Be realistic as far as what are your true expectations, because if you can do something like that and cut your cost down on a $700 trade by, $100 or $200, and you're wrong, well, you just saved $100 or $200 from yourself, and a $500 loss looks much better than a $700 loss any day. So keep that in mind, and especially if you don't think realistically we're going to move to those different prices, definitely something that you want to try and keep in the back of your mind as far as reducing that total exposure. Still risk defined, you're still hoping for the same thing, but you're cutting down on your total cost and you're bringing a credit back in to help offset at least a partial amount of that risk. So definitely have a few more things that I'd love to get across to you guys, a few more topics I want to talk about. But again, if you guys have anything on your mind, please feel free. You guys see the number up there. It's 877-927-6648. 877-927-6648. Please feel free to call in. I'd love to talk to you guys about your positions here. So, looking at a couple other things. We kind of talked about, we look at gold here. Just going to pull up GLD real quick, something a little bit more simple. I think something that more people have a little bit more access to. But let's pull this up, reduce this around, clean up my page here. Kind of look at GLD. So we have this ETF, right? It's gone up to 185. We've kind of rallied here to 175 or so, come back off, and we're now up to about 170. And this is something that I start thinking like, okay, I was wrong back in these days when I'm saying, all right, well, it's not going above 140, and it's not going above 150, and it's not going above 160. That's where I was saying I'm not very good at picking something that doesn't have a high in place. Well, now we have a high in place. And you see what it took to get there. And you know the dollar's not as weak as it was back then, so you kind of feel a little bit more safe about that upside. But you can look at something like this and start thinking, all right, well, what are the positions that we really want to get into? And I'm looking at this right now as kind of saying like, well, I think we've reached a bit of a peak here, you know, kind of going back to this small resistance. It was here, and even back here it was support and resistance. And a little bit more broader, maybe 4 or 5 points, a little bit higher. But you want to start planning for these things, right? And say, well, if we get to resistance, what is the position essentially that I want to have on? And this is really something that I think it's not a terrible idea to start thinking about selling some premium to the upside. And it's not a no-fear mentality as far as it was back here, where there's no volatility in the marketplace. You know, we're low, but it's not bottom of the barrel. So it's still I think people feel we have a little bit more sanity, we'll say, in the marketplace now. But you definitely want to keep an eye on this kind of thing. And this is one where I feel like gold, you can now start to play the range a little bit, whatever you're kind of feeling this range really is. And start looking at selling some credit spreads. And I mean, I've played with it a little bit. I don't have anything on right now, but still trying to look at, you know, what's the optimal position. I'm kind of thinking selling credit spreads to the upside, but maybe even, you know, let's pull some strikes out of the air. You know, 172. We'll say 172, 176. It's a buck. So about a quarter of your risk is there to be made. But it's one of those things where I'm not necessarily putting these trades on, but kind of waiting for the market to line up where I can get something like this on. I think if we rally a little bit more, maybe a little bit of volatility comes back into the marketplace as far as people starting to think a little bit of fear. Good thing about that drives volatility higher, implied volatility, and you can start to sell premium for a little bit better prices. So this right now, even if you're thinking we're going lower, and this is a March option, so playing out about 45 days or so. Check that date real quick. 45 days on the dot. So going out about 45 days or so, you're kind of looking at that and saying, all right, well, I can make $1.11 and feel somewhat confident in this 172, 176. Maybe if you think really this is the resistance, right? So we're talking about right here, and you've got $1 to go up to 173. But even something if maybe we rally a little bit more. What if we go up another $1, $2? Now we're trading 170. You can put the same trade on. Obviously, you're going to get more of a credit, especially if we get a little bit more volatility in there. So it's one of those things where I'm almost, you know, like throw something in there. Give me an indication. And this is a strategy I'll use a lot of times is say I want to do 10 of them. I'm not sure exactly what price I want to get in. I'm not sure when I want to definitely start looking at it. But if I can sell this at $1.80, then I'm going to definitely want to take a better look. And what I'll do is just throw one out there. You know, and you're going to want to watch, are you paying per share, do you have a ticket charge or things like that as far as commissions go. But a lot of times it's not a terrible idea to just throw a feeler out there. Offer it at $1.80. You don't have to then just eyeball this thing all the time. And if that's the price really you're comfortable with, maybe you look at here and we're trading, it triggers your trade. You get an alert, you take a look and say, okay, well now we're up at 170. What do I want to do? Let's revisit the marketplace. How much does the move look like it may continue? And you can then reassess the situation kind of from the point of view where you really feel like now is the time you want to start getting into trades like that. rather than putting all 10 in there and say we go up to 180 in the next 2 days. Not likely, but it could happen. And when you do that and you sell this at 180 and now you have to buy it back for 4, it's a terrible situation. So that's another reason that I'll do it this way, where if it's something I feel like it goes there for 2 seconds and it goes back and I only do 1, I say, wow, I could have done more. Chances are I wouldn't have done it if I waited, though. And more often it happens in the case where it really starts flying higher, and I sell it at $1.80 all in, and now it's a max loss. So definitely something that I think could be helpful as far as putting out those feeler type options. So let's go ahead and get moving forward. I got a few more things. If you guys have anything you want to call in, please feel free. I'll throw the number out, and we got a couple guys lined up. But 877-927-6648. We'll go ahead and start getting in with some of your calls here. So first guy in for the day, Matt, calling out of California. Good morning, Matt.
Good morning, Chris. I have a couple of questions, but first of all, I wanted to thank you and the show for a hint I got a couple of weeks ago when I was calling in about Google. I had the stock, and I was short the calls, and the recommendation you guys gave was, get out of that before the earnings, which I did. That was good.
Always get out of the options before earnings in Google. That's one of my things that I almost always do, especially on the short side.
Yeah, on this one it was particularly relevant, as it turned out. But I wasn't able to listen in last week, but I listened to the archived show, and there was something very interesting that came up. You had a professional options trader on, and he was talking about options going into earnings, and one of the things he was looking at was taking the straddle on a given stock. I don't actually remember which one you guys were talking about, but and then he added that amount to the spot. So let's say you have a $100 stock and the straddle is $10. He would look at the 110 calls and the 90 puts and compare the prices for those.
Sure.
And basically he was saying, if you see an imbalance, that gives you an indication for what the where the market sees the value.
Yep. I remember exactly what you're talking about. That was me in here, and I want to say it was Netflix that we were talking about, right? And the put, we were talking about the put skew. So essentially, the price of the puts were much higher than the price of the calls. And what's really interesting about something like that is you tend to start thinking that, okay, well, the fear is really to the downside. What's really crazy about that is the next morning, that was Victor and I did the show, the next morning I was talking to Victor, and I'm like, look at these Netflix options. After Netflix kind of rallied up the next day or so, that skew was gone. So the very next morning, if you went out the same amount in Netflix, they were the same price. So it was kind of like you got a feeling, and this is why I really try to pay attention to those things, because taking kind of a snapshot, you make a generality, and you can say, okay, well, it looks like here the fear is based in the marketplace, that we're going to the downside. But watching it over a day, and if you see that there's a skew to the put side and it disappears over a day, market sentiment has really, really changed going into those earnings.
So you look more
in that
at the
case,
dynamic.
That was right.
That was very right. Actually, I went in that way with a calendar spread, and that worked out pretty well.
That's great, yeah.
But the so you look not so much at the level, but at the movement in this skew.
I tend to, right. So in that case, I forget what strikes. I know we were looking at Netflix, but we'll say we went out 10 points, and it was, I don't remember the prices either, but we'll say the 10-point downside puts were $3, and the $10 upside calls were $2. So what that kind of tells us, like, okay, people are much more afraid of a move to the downside. You can kind of get, because that implied volatility to the downside of a crash is much higher.
Yeah.
But the part that became even more relevant is in just that 24-hour period, that skew flattened out. So I want to say, well, we'll just throw numbers out, that the 10-point downside puts were now 250, and the calls to the upside were 250. Which
so
makes people, if you were looked at that as kind of a snapshot, you say, okay, well, they're kind of up in the air. One of those directions, there's no real movement. But the important part was really that crushing of the put side skew as far as taking that volatility out of it. And what you really got a sense was, in just that short period of time, people aren't as afraid as they were before. And now why or how or what's basing that decision, I don't know. But for it to move like that, you need a lot of people to make that decision. And that's the part that becomes relevant to the retail trader, because you can't see that order flow take place like a market maker could. But you can see those prices move and get that same information.
Great. Okay. Thanks very much. If you have time for just one very quick one.
Yeah, fire away, Matt.
On the straddle itself, is there a way to tell, whether the straddle itself is particularly expensive or cheap? Is there a rule of thumb that you look at?
Not necessarily, because it's all based upon future expectations. So I'll let you. I appreciate the call, Matt. I'll let you go on this. Go ahead and hang up, and we'll go over, because I think Amazon has earnings today.
Okay. All right.
So why don't we take a look at that one? We'll see really as far as what are we thinking, cheap, expensive, and you guys can throw in your input as well. All right.
All right. Thanks very much. Bye-bye.
All right. I appreciate the call, Matt. So here's kind of what we're talking about here, and thanks again, Matt, for that call. But we're looking at Amazon. We'll go ahead and look at the 190 strike or so in Amazon. Let me just go right back to the weekly. So when you look at the weeklies for earnings, this is how I kind of like to play it, because really you're just looking for that move. It's a one-day event. And just because we're closer to 190, I'm just going to pull that up as the straddle that we're going to look at. All right? So here we are looking at 1840 for the Amazon at-the-money straddle. Now, some people will try and say, all right, well, let's look at the implied vol and what's a one standard deviation move for one day, and they have their calculator out. For me, with 3 days to expiration, I don't care about time value anymore, all right? Because if we move far enough away, if we move 20 points away, there's no time premium at that strike 20 points higher. So that's kind of how I play it, as far as if you're playing this from a long volatility position, you want to move, almost take time value out of it and say, if I'm wrong, it's going to zero. So you really want to just play, and that will essentially give you a little bit more wiggle room, because it's not going to go to exactly zero. And if we stay here right at 190, it's not going to be worth zero tomorrow. You know what I mean? But that gives you kind of an emphasis. Where do you have to go to break even? And you look flat out. All right, it's 18. I'm just going to make the math easy here. We'll put this in at 1850. You know where you have to go. You have to go 1850 higher or 1850 lower than 190. If you don't, and we're only 15 points lower, you're still probably going to lose. You're still probably going to lose on that trade if the volatility comes out enough. You might have a short period of time where you can get out for maybe break even or a slight gain, but you want to take a look at that and say, I'm willing to lose that whole amount. Now, do I think we're moving 1850 or not? You can skew it a little bit and say $17 or $16, and play it a little bit. But this close to expiration, you don't want to get too fancy, because you have to have that expectation that you could lose everything. But 1850 is the price. And it starts to become, well, is vol too high or too low? You go back and look at, well, what you have available to you, right? Well, I have this weekly vol is 115, and everything else is in the 40s, and there's 60 for the monthly. And you can say, well, it's too high, sell it. The problem is these don't have as big of a factor of earnings. You can go out to January, and it's got 3 or 4 more to go in terms of earnings. So, of course, this month doesn't care. So this is really where you're looking for, is this front month, and it becomes difficult to look at those back months. Now, one of the other things you can do is look at the implied volatility here. Say, okay, well, how high did it get? We're still above kind of like this 60 point, because this is looking at a 30-day implied volatility. So we're going to be above that. You would really expect that. So then it starts to be, all right, let's forget about implied volatility for a second. Do I think it's going to move 1850 or not? And you can kind of just go back. And what I'll tend to do is just look at past earnings. So here's one from back in October. And where did we close? 227, and the next day we were down at 200. So it moved about 27 points. If you can buy that straddle for less than 27, that worked out well. Move back again. Here's the one previous. We went from 215 to about 225. maybe you could have got out there. So we'll just say 10 points. Come back here, and the next day we actually opened lower than where we closed the previous day. So I take that back. Closed 182, opened 183. So open a buck higher, and then we got a big range, So we'll say 182 up to 197. So about 15 points. Looking at just those earnings, $18 seems high to me. The only reason I think it's high is because we had this big move back in October. So I look at something like that and I say, relative, and we're looking at three earnings don't make a trend, and you can go back further than that if you want. Just kind of take a look as far as what typically happens. But I'll kind of set a general guideline and say, okay, $18, what would have worked out in the past? Selling it would have been better, selling it would have been better, buying it would have been better here. And then try to say, well, if I sold it for 18, what do I expect I would have made? What do I expect I would have made? And what do I expect I would have lost? Kind of look at those different things. So you can kind of say, me looking at this, I kind of think it's a little bit high. The one reason I think it's high is because I think people are still just afraid of this last big move, and they're afraid that could happen again. And the people who are short during one like this say, I'm not getting short again. So whether they're long and they won't cover or they're short and they do cover it, that's going to keep that price inflated a little bit in terms of implied volatility. The people remember most the very last one is basically what I'm trying to get at there. So I think that's going to influence the price and make it worth a little bit more. If this one did not occur and we were just looking back at these past two earnings, I would say, yeah, 18 might be, that's a good sell. But I don't think it'd be worth $18 at these times. You could always go back and look. So $18, I think a little bit high, 18.5 at this point. And one of the other reasons I think is because now it's essentially all the news from the Christmas season, right? So the holiday season. How well did Amazon do? What did they sell? How many things did they get out of that? And I still kind of feel like around Christmas time, if you're watching Bloomberg or CNN or CNBC, you were just inundated with Amazon news. How many Kindles did they sell? How much product are they selling? How many packages are they shipping? So I feel like anybody analyzing this stock with any degree of intensity as far as really trying to get details kind of has a pretty good picture as far as what's going to happen anyway. And whenever you have more than a few people that have kind of that good feeling as far as what's going to happen, you don't get a ton of volatility in the real marketplace because they kind of know the news that's going to come out. Now, they could be wrong, and of course they don't have all of the details, and there's still some private information that has to be disclosed as far as changing plans or what's going on in Amazon. So certainly things can change, but if they just come out and say, okay, we met and everything, all of the news is essentially what we disclosed over the last month and a half, it's going to be ho-hum and we kind of sit still. So for that reason, I kind of feel it's priced fairly high. And then you can kind of say, well, if you sold this, let's say you sell this spread, right, $18.50. What's your risk in the trade, right? And you can get out your calculator and say, well, it can go to infinity, so my risk is infinite to the upside, and I'm risking 172 points to the downside. Well, it's not going to zero, and it's not going to infinity. It may, but I don't think that's going to happen. So now you kind of say, realistically, where do I think this thing is going to go? And you can say, well, when it really ripped, back at this time, we went from closing at 227 to the next day being down to about 200 or so. We'll just go to the middle of that range. So 27 points. You can kind of say, like, well, if we went from 1850 and moved 27 points, what do I lose? $9. So you lose 9 points on a spread like that, and it's almost like, well, that's less of a concern. What if we move 20 points? Well, you're going to lose 1.5 or 2 points or whatever the case may be. I don't feel like the risk is that great that we're moving to those extreme measures, and if we do, how much further are we really going to move? Usually when I say something like this, Amazon's going to be trading 300 tomorrow, but it's one of those things where, me personally, even if I were to do this trade, short these options, I'm probably going to think about covering some of that risk anyway to the up and downside by trying to maybe buy some cheap options. I shouldn't say cheap, but farther out of the money options, just because if it really does rip, I don't want to be left exposed for those crazy degrees, as well as it's going to help cover some of that buying power, some of that margin requirement if you clean up some of that outside risk as well. I was talking to somebody today about, thinking that market maker mentality, and we always kind of think like, how many bullets do you have left? How much can you sell, before the risk manager says, hey, that's too much? And it happens a lot of times where most market makers prefer to be short, prefer to collect theta. And to be able to do that, they'll go out and just buy cheap options when they can, not when they have to. So they buy kind of those further out cheap options. Now they're long out of the money puts, long out of the money calls. It gives them essentially the freedom to be able to short the stock when they want to. Short the options when they want to. So having that freedom, having that ability to really put on those positions when you want, and be able to scale up on the size even, because you have those bullets, because you have that protection to your up and down side is one of the things you want to keep in mind. So even though I think based on this, again, it's an imperfect science, and we're talking Matt saying, how do you know if it's too high or too low? You really have to go, what are your expectations and what's happened in the past and what is it worth right now? And really go from there. The reason there's a market and the reason you'll see it go up and down is because everybody thinks differently. I think it's too high, you think it's too low, and so on and so on. So take those skills, take those tools, and really try and figure out what do you think. But as always, try not to leave yourself exposed with the risk. Define the risk, protect yourself, live to trade another day. So on that, I appreciate the call from Matt. I hope I helped you guys out with a few different things. Be happy to be back. I think Victor's going to be back next week. We'll try and sit in with him and go over a few more things. But please, next time, feel free to call in. We'll get some more things. And God bless you guys. Have a great day. Take care.